everyone. Today is Tuesday, January 13th, 2026. Hope everyone is doing well, mentally and physically. Welcome to another episode of Tax and Accounting Ride Along, brought to you by Sands Virtual Enterprise, LLC, your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer in the general public. Today, we are going to be diving into an overview of the taxation of an LLC. LLCs are flexible business entities and can be structured for huge tax advantages while providing limited liability protection. Today's episode is on perfect timing for the start of the tax season, providing you practical insights to save on your taxes as you literally get ready to file in a few weeks. So without much further ado, let's crank it up and get straight to it.
Today, we're wrestling with, probably the most common business structure in the U.S., the limited liability company, the LLC. Everyone seems to rush to form one for that liability shield, that delicious protection for your personal assets. But the second the paperwork is done, they just freeze. Why is that?
Because the legal part is actually pretty simple to create, but the financial strategy that comes after, not so much. The LLC is kind of a blank slate for the IRS.
The blank slate.
Yeah, it gives you the legal protection, but then it turns around and asks you, the owner, okay, so how do you want to be taxed? And if you don't answer that question strategically, you just leave serious money on the table.
Exactly. And that right there, the core rules of LLC taxation, that's often the biggest roadblock for new and honestly even established business owners. So for this deep dive, we are getting surgical. We're going to demystify how LLC profits are actually taxed, from the default structure all the way to the critical strategic election options, to help you, our listener, quickly get a handle on the core financial rules. Okay, let's unpack this.
To start, we have to lay the foundation. And the foundation, the single most important concept, is avoiding double taxation. That's the entire appeal of the default LLC structure.
Okay, so tell us what that means in, practical terms.
By default, an LLC is categorized as what we call a flow-through entity.
Flow-through.
And that just means the business itself, the LLC, it does not pay income tax. The profits, the losses, they flow directly through the company to the owners. We call them members. And those members pay the tax on their personal income returns.
And to really get why that's so important, we have to look at the structure it's designed to avoid, which is the traditional C corporation.
Precisely. If you're running as a C corp, you face double taxation. It's a two-layer problem.
Layer one.
The corporation pays tax on its net profits at the corporate tax rate. That's tax hit number one. Then, layer two, when that corporation distributes the profit that's left over to shareholders as dividends,
they get taxed again.
The shareholders pay tax on that same money again, but at their individual rate. The LLC's default setting just bypasses that entire first layer. It's clean, it's efficient, and it avoids that really punitive second tax hit.
That makes the default so appealing. You get the legal protection without the tax penalty. Now, how does the IRS figure out that default setting, the one that applies if you just, do nothing?
It's actually a very simple head count. The IRS just looks at the LLC and says, are you one person or are you many?
Okay, let's start with the solo operator, the single owner.
So if you set up a single member LLC, an SMLLC, the IRS by default treats the business as and this is a technical term, a disregarded entity for tax purposes.
Disregarded entity? That sounds a little dismissive.
It does, but it doesn't mean the entity is ignored legally. You still have that all-important liability protection. But for taxation, the IRS it pretends the LLC isn't even there.
So what does that mean when I'm actually filing my taxes?
It means the LLC doesn't file its own separate tax return. All the income, all the expenses, they flow directly onto your personal tax return. Usually you'll report it on a Schedule C, profit or loss from business.
So tax-wise, it's basically a sole proprietorship.
Exactly. It functions just like one, but you get to keep all the legal benefits of the LLC structure.
Okay, that makes sense. A disregarded entity files on Schedule C. So what about an LLC with two or more owners?
If you have a multi-member LLC or an MMLLC, the default is that it's treated as a partnership for tax purposes.
So the flow-through is still happening, but the way you report it is different, right?
Exactly right. The MMLLC files an informational tax return, that's Form 1065, and it basically just tells the IRS how much money the business made. But, and this is critical, the business itself still pays zero income tax.
So where does the tax get paid?
Well, the profits and losses are divided up usually proportional to each member's ownership stake, and then reported to them on a special document called a Schedule K1.
The K1.
Right. And then each member takes that K1 and uses it to report their share of the income, and that's where they pay the tax on their own individual returns.
So the big takeaway here is that whether you're one owner on a Schedule C or a bunch of owners using K1s, the money and the tax liability, it all lands on the individual's personal tax return. The company is just a conduit.
That's the structural brilliance of the flow-through system.
Okay, let's shift focus.
Right.
We've talked about the entity. Let's talk about the individual member, because this is where the real cost of doing business can hit hard. We know the profit flows to the member, gets taxed at their personal rate, but there's a second massive financial bucket that so often blindsides new business owners. And here's where it gets really interesting.
Absolutely. The profits that flow through to you as a member, they're subject to two crucial types of tax. First is the standard individual income tax, based on your bracket. Second, and this is the one that hurts,
Self-employment taxes.
self-employment taxes. This is the financial gut punch for every new entrepreneur.
It really is. Explain why.
Well, think about a regular W-2 job. Your employer pays half of your Social Security and Medicare taxes. That's the employer's portion. And they withhold the other half from your paycheck.
Right.
But as an LLC member, you're considered self-employed. So the IRS says, congratulations, you get to pay both sides of that. You are effectively the employer and the employee.
And what's that combined rate? The number that everyone listening needs to just burn into their memory.
The combined rate for self-employment taxes is 15.3%. 15.3%.
Wow.
And that rate is applied to your share of the LLC's profits. It's mandatory. And it's on top of your standard individual income tax rate.
So let's put that into perspective. If you earned $100,000 in profit from your LLC,
over $15,000 of that is immediately gone for the self-employment tax. And that's before you even think about what income tax bracket you're in.
that 15.3% is truly the cost of being your own boss. It's a number that really has to stick with you.
And that specific pain point, that mandatory 15.3% tax on all your net earnings, that's what drives this entire conversation around strategic tax elections. Businesses see that number, and they immediately start looking for ways to legally reduce the income that's subject to it.
Which brings us perfectly to the power of choice. Because LLCs aren't locked into being a disregarded entity or a partnership forever, they can elect to be taxed differently. And this election, this decision, is arguably the most critical strategic financial move you can make.
The liability protection is just the foundation. The tax election, that's where you find the real financial advantage.
So let's start with the undisputed champion of strategic elections, choosing to be taxed as an S corporation. What's the main goal there?
The goal is explicitly to attack that 15.3% self-employment tax. When an LLC elects S Corp status, it still keeps the huge benefit of flow-through taxation, so still no double tax. But it changes how the owner's income gets categorized.
How does that split actually work?
It lets the owners who actually work in the business split their income into two separate streams. Stream one is a mandatory, quote, reasonable salary.
A salary.
And that salary is subject to the normal payroll taxes, including that 15.3% tax. But stream two, which is all the remaining profit, can be taken as an owner distribution.
And the distributions.
Those distributions are generally not subject to self-employment tax.
Okay. So here's the strategy. If my LLC made $100,000 in profit and I decide that, say, $50,000 is a reasonable salary for the work I do, I only pay that 15.3% tax on the $50,000.
Right.
The other $50,000 in distributions avoids that huge tax hit entirely.
You got it. It shifts a huge chunk of your profit out of that self-employment tax bracket. But, and this is a big but, the IRS is extremely vigilant about that reasonable salary requirement.
You can't just pay yourself $1.
Exactly. You can't pay yourself $1 a year and take $99,000 as a distribution. The salary has to be defensible. It has to be based on what someone in your role would earn in the open market.
That's the critical detail. It's a powerful strategy, but it requires careful compliance.
Are there other, maybe more niche elections in the sources?
Yes. While it's far less common than the S-Corp, the source material does mention the Qualified Personal Service Corporation, or QPSA. election.
PSA.
Yeah, it's highly specific. It's usually for companies where the value is almost entirely in the individual skills of the owners. Think law firms, accounting practices, medical groups.
And what's the specific benefit for them?
It allows the firm to deduct certain employee fringe benefits, things like medical plans or other perks, that would otherwise be non-deductible expenses if they were just a standard partnership. It's a niche benefit for very specific industries. Okay, now let's pivot to what seems like a really counterintuitive choice. Electing to be taxed as a C corporation. I mean, we started this whole deep dive praising the LLC for avoiding double taxation. Who on earth would actively choose the C Corp structure?
It is rare, and it almost always involves a very high-level growth strategy. The core driver is usually outside investment.
Venture capital.
Exactly. C corporations can issue different classes of stock, and they're structurally familiar to institutional VCs or other big investors who demand specific ownership structures. If your end goal is an IPO or massive growth funded by outside equity, the C Corp structure is often a requirement.
But you are paying a huge tax cost for that flexibility.
Absolutely. The critical drawback, and you have to weigh this so carefully, is that you are reintroducing double taxation. You are sacrificing all that tax efficiency for corporate flexibility.
So profits are taxed at the corporate level.
And then they're taxed again at the individual level
Right.
when they're distributed as dividends. Unless you have a very specific, complex growth reason, electing C Corp status is a huge financial step backward.
So it really comes down to your business goals. If you're a single-member consultant trying to be tax efficient, the S Corp is probably your move. If you're a startup trying to attract VCs, C Corp might be a necessary evil.
That's the strategic summation right there. The LLC is just the legal wrapper. The election is the financial engine inside.
That's a fantastic overview. So once the listener has made their choice, whether it's the default or a strategic election, what does all this mean for the practical day-to-day, for staying compliant?
This is where we shift from strategy to execution. And compliance, really. Longevity. It hinges on 3 core practices, no matter what your tax classification is. First and foremost, meticulous record keeping. It's essential.
Tracking every dollar in and every dollar out. It sounds boring, but it's totally non-negotiable.
It is, especially for a multi-member LLC. You need excellent records for income, for expenses, and critically, for ownership stakes and distributions to file those K-1s correctly. Second, you have to be aware that tax laws are not static. They change.
Right.
The rules around deductions and self-employment, they're always being adjusted. Staying updated is absolutely necessary.
Which brings us to what might be the most important piece of advice from the source material. The absolute need for professional guidance. This is not DIY territory.
Not at all. I mean, navigating the 15.3% tax, the strict rules for a reasonable salary in an S Corp, the filing deadlines, it all demands expertise. You absolutely must talk with an experienced, qualified tax professional like a great CPA or a tax attorney at 3 key moments.
Give us the checklist.
Okay, number 1. When you're first forming the LLC, don't just default into a structure without thinking, especially if you expect to be profitable. You need to start off on the right foot.
Makes sense. Number 2.
Anytime you're actively making tax elections, deciding between a partnership and an S Corp, for instance, because the compliance burden shifts dramatically. And number 3, anytime you're navigating complex situations like adding or removing members or dealing with different state-level tax laws.
That's a perfect checklist for when that DIY instinct needs to take a back seat.
Oh, absolutely. The difference between the wrong choice and the optimal one could be thousands and thousands of dollars every single year. It's an investment that pays for itself almost immediately.
This has been a fantastic deep dive into financial efficiency. Let's quickly recap the key takeaways for you, the listener. First, the default LLC structure is flow-through, which successfully avoids double taxation.
Right.
However, the owner carries a significant tax burden, specifically that non-negotiable 15.3% self-employment tax on profits. And finally, electing to be taxed as an S corporation is the main strategic tool you have to mitigate that massive tax liability by separating your salary from your distributions.
Correct. And this entire discussion, I think, it raises a really important question for you, the listener, to consider as we wrap up. Given all this complexity and the wide array of financial elections available, from a disregarded entity all the way to a C Corp, is the legal structure of the LLC as important as the tax structure you elect for it?
That's a fantastic challenge to leave with.
For so many businesses, the real strategic decision point isn't when you file that initial formation paperwork. It's the optimal tax selection that comes after. I mean, if you just default into a structure that isn't the most efficient for your level of profit, you are literally creating an annual financial opportunity cost for yourself. And that's a powerful thought to mull over before you have your next conversation with your tax advisor.
A truly strategic decision that you can only make after you understand these critical flow-through rules. Thank you for providing the material for this deep dive.
My pleasure.
We'll catch you next time.
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride-Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 404-5858513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.